This problem involves three parts. So we're going to be doing the cost of goods manufactured, the cost of goods sold, and the income statement. These three sections are all part of one large problem, and you need to do the sections in the correct order, starting with the cost of goods manufactured, then cost of goods sold, and then income statement. So the problem that we're looking at here is called Victoria Manufacturing Limited. And Victoria Manufacturing makes park benches. And you have in front of you in your problem the data set that pertains to the company. So what I'm going to do to illustrate how to solve the problem is that I'm going to basically take the given information and I'm going to insert it in the schedule in the sections where each element should go. So first of all, we're going to look at our work in process schedule. So we're starting with the first line item, which is our beginning work in process. And you can see from the information that we are given, the beginning work in process is $30,000. So we'll just enter in our $30,000. Then what we want to do, we want to figure out how much materials we have used during the period. And throughout the lectures and in the book, and just even if you happen to be working in this environment, you'll hear the terms direct materials and raw materials. Those two terms tend to be used interchangeably. So we're trying to figure out how much materials we actually used. So the normal way to start this is you would identify how much materials you had at the beginning of the period. So if the beginning of the period, as in this case, is January 1, you would look to see how much in raw materials did I have left over at the end of December. Well, in this particular instance, we're told that we started the period with $50,000. So we'll just enter in 50,000 here. Then we're told that during the period we purchased raw materials of $100,000. So you'll see that's the 100,000. So we'll key in our $100,000 worth of materials purchased. So what this means is we had a total raw materials available for the period of 150,000, comprised of the 50,000 we started with at the beginning of the month. Then we purchased another 100,000. That gives us 150,000. So in order to figure out how much we actually used during the period, we have to subtract what we were left with at the end. So we are told that at the end of the year, you had $80,000 worth of raw materials. So you're going to be entering that in here. And then you subtract the 80,000. So it's 150 minus the 80. That tells you you've used $70,000 worth of raw material. The next piece of information is the direct labor. So there's no calculations required for direct labor. You are just given the amount, it's $90,000, and you enter it in. Now for the next category of costs that make up your manufacturing cost is manufacturing overhead. So manufacturing overhead is comprised of all of the different types of expenses that are required to run your manufacturing operations. So the first one is indirect materials. So indirect materials generally refers to the small items that you need to run your operations. So it could be small nuts and bolts and lubricants, things of that nature. So generally small amounts that you need to run your manufacturing department. So in this case, we're told that our indirect materials are $50,000. So we'll enter in 50,000 here. Then our indirect labor. So these are not the labor costs that are related to actually making it. The indirect labor refers to, for example, your supervisory staff, your cleaning staff, security. So you need to have these people there to run your manufacturing operations. So we're told that indirect labor is $50,000. The next category is insurance. So you have to have insurance on your factory. So in this particular company, they're renting their facility, so they don't have to insure the actual factory. What they're really insuring is the contents, so all of the machinery that they have inside of that building. So we're told that our insurance for the factory is $2,000, so we'll enter in $2,000. And we have, of course, the factory rental costs, which is $24,000. The final category for manufacturing overhead are the utilities costs. So this would generally represent your heating and electricity cost. So that amount is $6,000. So now we have identified all of the cost, and we made a little data entry error right here. So instead of 50,000, this should have been 5,000 right here. So now you have all of your cost. You now have all of your costs listed here, all of your indirect overhead, and that is adding up to $87,000. So what you're going to do next is you want to add together the materials that you use during the year, plus your direct labor, plus your overhead. So that is going to, those three will add up to $247,000. So that's the manufacturing cost you've incurred. Plus, at the beginning of the year, you had work in process. So what work in process really means is during the previous month, you were working on making those park benches, but they weren't fully complete at the end of December. So you're carrying forward the partially completed benches along with the cost that you incurred last year. So you're going to finish those this year. So your work in process, 30,000, gets added to the new costs that you incurred during the year of 247. So the total work in process is $247,000. You're going to add the 247 to the 30,000 to come up with 277. So that's your work in process during the year. The next step is, you know that you very rarely finish 100% of the items that you're working on during the year. So you're always going to have some of your products at the end of the year that will be partially complete. So here we're told that our ending work in process is $40,000. So we're going to subtract that from the 277. So that gives us a total of $237,000 for cost of goods manufactured.
Just click that little C in the bottom right for go over. No, the other side. Go over to see the little C.
Oh.
Click that. See, there's a pause button there.
Yeah.
You can always go there and hit the pause button. And
Okay.
Either way, we can edit this.
Yeah, okay. Yeah, so I made a mistake when I entered that in, but then I went back and corrected it. That's okay.
Then that's fine. So
Yeah.
so yeah, for future, if you need to pause,
Yeah.
click that little C and that'll come up, and then you can hit the pause button.
Oh, okay. Because I was panicked. I knew when I did it, and then I couldn't figure out what to do. Okay.
Are you done with this one? Are you still gonna? Okay, and if you're done, then you can just hit the stop button or the F10.
Okay, so now I'm going to start up again.
So you can,
Do the next part of this.
it's going to be the same equation.
Yes.
Do you want them as separate videos?
No, I want this all together.
Okay, that's fine. You can just continue here and I'll make sure I edit it.
Yeah, so do I?
No, you don't have to do anything. You can just click back on Excel and continue.
Okay. So that completes our cost of goods manufactured. So what cost of goods manufactured really means is all of the goods that you completed during the year. This is the total cost related to those items, $237,000. So now the next schedule that we're going to complete is our cost of goods sold. So we want to start off with what goods have we actually finished at the beginning of the period. So typically all of the goods that you make in a year, you're not going to have them all sold at the end of the year. Rarely works like that. So you will typically start off at the beginning of the year with goods that have been finished but have not been sold. So when you're looking at the information that you're given there, you will see that your finished goods at the beginning of the period is $80,000. So we'll enter in $80,000. Then we know that our cost of goods manufactured is $237,000, which we took from here, from our cost of goods manufactured schedule. So the total cost of the goods available for sale is $317,000. But as I just mentioned, we weren't fortunate enough to be able to sell all of those during the course of the year. So you're told in the problem that there was $90,000 worth of goods that were finished but were not sold at the end of the year. So we'll enter in our $90,000. And we want to subtract that 90 from the 317, so that gives us a cost of goods sold of $227,000. So that completes our cost of goods sold schedule. So finally, the whole reason you're doing these two calculations, your cost of goods manufactured and your cost of goods sold, is so that you can prepare your income statement. So that's the next one that we're going to do. So in terms of the sales, so we're going to enter in the sales, and we're told in the problem that the sales are $600,000. And our cost of goods sold, which we've just calculated to be $227,000, we'll enter in that, because what we want to do, we want to subtract from the cost. You have your sales, and you want to know how much those products cost that you sold. So they cost $227,000. This means you have a gross profit of $373,000. However, we're not done just yet. We want to now look at deducting our administrative type of cost. So here we're given two cost categories. So we deduct our marketing cost. Then we also, the next item we deduct is our administration costs, and we're told that's $50,000. So we'll just make sure we put in our little comma here. So we have these costs deducted as well. So that brings us down to a net income of $300 and so what we are going to do now is our income statement. And we are given in the problem that the sales are $600,000. So we'll key that in. Then our cost of goods sold, which we've just calculated here, is $227,000. So that gives us a gross profit of $373,000. So of course, we're not done yet. There are other costs of running the organization. So here we're told that we have marketing cost of $20,000, and we have administration cost of $50,000. So that gives us total marketing administration of $70,000, which you deduct from your gross profit. This will leave you with $303,000 net income. for Victoria Manufacturing Limited.
F10.
This next problem that we're going to do is comprised of several sections, but it's all related to the same organization called Healthy Smoothie Shakes. And cost, volume, profit, or you'll see it called CVP. This methodology is a really quick way for accountants to do analysis without having to recalculate the full income statement. So the idea behind it is when you calculate your contribution margin, which is your selling price less your variable cost, that is contribution margin. This provides extremely useful information that you can use to do various what-if analysis. So you can look at, well, if I increase my price or decrease my price or increase or decrease my cost, what impact will this have on my bottom line? So that's the scenario that we're looking at here. So the first part of this problem is asking us to calculate break-even sales in dollars using the contribution margin ratio. So when we use the term ratio, we're looking at the percentage. So what percentage is contribution margin as a percentage of selling price? So we are told here our selling price is wrong spot. Here we go. Our selling price is $6. And we're told that our variable cost per shake is $2. We'll enter that in. So that means the contribution margin per shake in dollars is $4. Now what we're looking for, what we're asked to do is the ratio. So in other words, what percent is 4 divided by 6? So it's 67%, 0.67. So once you have this information, this then allows you to analyze the data more in depth. So the first thing we want to do here is, what we're being asked to do, is calculate the break-even sales in dollars. So how much do we have to sell to cover our fixed cost? So when you're looking at break-even, you're only looking at covering your fixed costs. Your operating income will be zero. Break-even implies that you're not making any money, but you're just covering your fixed costs. So people calculate break-even because they want to know, well, what is the minimum I have to sell to cover my fixed expenses? So in this case, we're told that your fixed expenses are $5,000. So it's 5,000 plus 0 for operating income, so it's still 5, divided by your contribution margin ratio, which we've just calculated here. That tells you the break-even sales is 7,500. So at break-even, there is no operating income, you're just barely covering your fixed cost. So that's the first part of the problem. The next part of the problem is taking it one step further, and now we do want to make some income. So in this one, we're asked, well, what are the target sales in dollars? So how much do I need to sell in order to cover my fixed costs plus earn a monthly income of $9,000? So what we want to do here is we are going to enter in our $5,000 of fixed cost. Then we have our $9,000 desired operating income, and that is divided by your 67. So we want your 0.67. So you have your 5 plus your 9 divided by 0.67. This tells us that you need to have monthly sales of $21,000 in order to cover your fixed costs and make $9,000 in monthly income. So that's the end of part 2. Pause for a second. Where's my resume button?
Or you didn't pause, actually, you just brought it up. You're still recording, it's fine. You can just minimize that and continue. I'll edit that out.
Okay. Part 3 is asking us to calculate healthy smoothie shakes operating income. So what we are going to do, first of all, we know what our contribution margin is. We just calculated that as being $4 per unit. So we'll just enter in your contribution margin per unit, which is $4. Then we're told the number of units sold, and you're given that in the problem. It's 4,000 units. So this gives you a contribution margin of $16,000. So this is really like a shortcut to completing your income statement. So you now have your contribution margin. The next thing you want to do is deduct your fixed cost, and the fixed expenses, we're told in the problem, that's $5,000. So we'll key in 5,000. So that means you had an operating income of $11,000. So as you can see, once you know your contribution margin per unit and you know how many units you sold, you can very quickly identify what your operating income would be. Now it's important to distinguish between managerial accounting and financial accounting. When you're preparing your financial statements as under financial accounting and you're going to issue them in an annual report, you wouldn't use this method. You would come up with the same income, but you would have to use your full income statement format. Well, the purpose of this shortcut method is to enable the organization to very quickly identify if they make various changes, say in the selling price or in their variable cost. They can very quickly see the impact it would have on their operating income without a whole bunch of calculations. So that ends part 3. So the next one that we want to look at, which is really the whole idea behind cost, volume, price concept, is you want to look at making some changes. So what about there's a new player in town, another company selling healthy smoothie shakes, and their prices are lower than yours. So if you want to address the competition, you're wondering, well, what about if I decrease my price from $6 down to $5? So that's what we're going to do here. So now your new selling price will be $5. And your variable cost, we're not told that there's any changes in the variable cost, so that means the variable costs are still $2. So we'll enter in our $2 here. So that means we have a contribution margin of 3. So now, as a result of lowering your price, the company expects now to increase the number of units sold to 5,000 units. So here, instead of 4,000, so we'll enter in our 4,000. So this will give us a contribution margin of 12,000. And our fixed costs, we are not told that there's any, yes, we are told that there is a change in fixed costs, so they are increased to 6,000 from 5, so we'll deduct our 6,000 in fixed cost. So this leaves us with okay, the next part of this problem, section 4, calculate revised operating income after the following changes. So this really is the whole reason behind using cost, volume, profit, because it very quickly enables you to see the impact of making changes to your selling price. So here we see that we're told we're going to reduce our selling price from $6 to $5. Our fixed costs are going to increase to $6,000. And then we also expect to have an increase in the number of units sold to 5,000 units. So we'll just go through the calculation to see what impact reducing our fixed prices will have on our bottom line, on our operating income. So the selling price is $5. The variable costs remain at 2 because you're not told that there's any change to variable, so you assume it's still $2. So that means your contribution margin is now $3 instead of $4. And as a result of decreasing your selling price, the company is now selling 5,000 units. So we'll enter in our 5,000 units. So this gives us a contribution margin of 15,000. But we still have to remember to deduct our fixed costs. So our fixed costs here have increased to $6,000, so let's subtract that, and that leaves us with operating income of $9,000. So if you were advising the company, you would tell them not to do it, because by lowering their price, they did sell more units. They sold 5,000 instead of 4,000, but they ended up with a lower operating income, so they wouldn't do it in this particular instance. So that ends part 4.
You have 10.
So the 5th section of the calculations that we are going to do for healthy smoothie shakes. Here we're going to do several calculations. The first one is looking at the different product mixes that would be most desirable for the company. So in this scenario, we are looking at the shakes as being large or small. So you can see the selling price for the large is $6, the variable cost is $2, the small shake sells for $3 and its variable costs are $1. And in terms of the sales mix, we are told in the problem that for every one large shake, the company sells 3 small shakes. So it's 1 large for every 3 small. So that's the sales mix. The total company fixed expenses is $18,000. So that's combined, regardless if they're making just large shakes or small shakes. So the fixed expenses are $18,000. So now what we are aiming to do here with this problem is to identify what our weighted average contribution margin is and our total contribution margin with our sales mix of 1 and 3. So we'll start off by entering in the information that we are given here. So we are told that the price of the large shake is $6. Oops. $6, and the variable cost is $2. And we know in terms of our mix, we sell 1 shake for every 1 large shake for every 3 small shakes. So the contribution margin per unit is 4. So the next thing that we want to do is now go back up here, enter in the selling price for the small shakes, which is $3. The contribution or the variable cost is $1. So your contribution margin is $2. So here you're looking at your sales mix. So we know we sell 3 and they're $2 each. So that's where 2 times 3 is your $6. So with the current sales mix of 1 large for every 3 small, we get a contribution margin of $10. So now what we want to do is do the weighted average of that. So we take our $10, we divide by 4, which gives us a weighted average contribution margin of $2.50. So that ends Part 5A. So now we move along to Part 5B. So we are going to calculate the total break-even sales in units. So we are going to be using your weighted average contribution margin that we've just calculated, our $2.50 in this calculation. So we have to basically, we're only looking at, because we're calculating break even, we're only looking at how much do we need to sell to cover our fixed costs. So our fixed expenses we're given up here is $18,000, so we'll enter in our $18,000. And we know our weighted average contribution margin is $250, so 18 divided by the 250 will give you 7,200 units. So what that means is that's the total number of large and small combined. What we now need to know is how many small and how many large. Well, we know that that ratio for small, remember that we said for every 3 small shakes that were sold, the company will sell 1 large. So out of a total of 4, 3/4 are for the small shakes. So 3/4 times 7,200 will give you 5,400 small shakes, and then 1/4 of 7,200 will give you 18,000 large shakes. So we now see how many of each that we have to sell in order to break even. So this is just covering fixed. It's just your 18,000 with 0 operating. So there's a way to prove that this calculation is correct. So now we'll just go through the actual revenue and variable expenses, so on. So do a full income statement to show that this actually works. You don't have to do this. If you're asked in a problem to calculate break-even sales in units, you only need to take it to here. But I'm doing this for illustration purposes only to show you that this shortcut method does in fact actually work. So the sales revenue for break even, you're going to sell 5,400 of the small shakes, and their price is $3 each. And then we're going to sell 1,800 of the large, and their price is $6 each, which would give us 27,000. Variable expenses, we just use the same information that we had before, so that comes to 9,000. Contribution margin is 18,000 less your fixed expenses. Operating income of 0. So that ends the proof demonstration. So now that we have calculated in this problem 5B, calculate the total break-even in sales in units, what we're going to do, the proof is to do the full income statement format to show that this shortcut method does actually work. So the sales, we are going to be selling 5,400 small shakes at $3 plus 1,800 large shakes at 6,000. So that, when you multiply that all out and add it up, it comes out to $27,000. And our variable expenses are the same, of course, for both units. So 5,400 times 2, 1,800 times 2, that will add up to $9,000. Should be 9,000. I forgot my zeros here, so that's better. So contribution margin of 18,000, and you will recall the total fixed expenses for the company is 18,000. So we'll subtract our 18,000 in fixed costs, which will give 0 operating income, which is what we mean by break even. So you can see the shortcut method works just fine. So that ends section 5B. So the last section that we are doing here is 5D. So 5D is introducing another calculation which is called operating leverage factor. So the first thing we want to do is calculate So we're going to have to re-record this session, and we're going to have to redo this one completely. Okay, this section 5C, we're going to introduce a new formula, and it's called operating leverage. So the first thing we want to do when you calculate operating leverage, you have to calculate, first of all, the first step is calculate margin of safety. So margin of safety, what this means is you're really calculating how much more you're selling over break even. So you look at your break even sales, which is 27,000. So we'll enter this in down here. It's 27,000. Margin of safety is what is your actual sales, which is 40,000, minus the 27,000, which will give you 13,000. So that's your margin of safety. So you're selling $13,000 worth of product over and above what's needed for break even. So that's your margin of safety. Now the next thing you want to look at is your operating leverage factor. So that's defined as your contribution margin divided by operating income. So your contribution margin here is, and we'll just pause. Way down here. I have to This next section of problem 5 that we are looking at, problem 5C, we're going to be doing a couple of calculations here. The first one we're looking at is margin of safety. So with margin of safety is we're looking at how much higher your actual sales are than the break-even sales. So how much are you making over the minimum that you have to make to cover your fixed costs? So our actual sales are $40,000, and we know that our break-even sales is 27. So 27 minus your so 40 minus your 27 is 13,000. So that was 40,000 minus your 27,000. So that's where the 13 comes from. So that's very helpful when you're looking at your sales. You know that in this particular instance, you're quite safe here in that you're actually making $13,000 over and above what you need to cover your fixed costs. So if for some reason your estimates were off or something happened, maybe there was a storm and you had to close your shop for a couple of days, you know that you're still probably going to be okay in terms of covering your break even because you're well above that. So now the next thing we want to look at is operating leverage factor. And this is again another shortcut to see if what the impact of changing your volume would be. So we're going to start off here with your contribution margin. Your contribution margin from up here that you're given is 20,000. So we have a contribution margin of 20,000. Then we have to divide that by your operating income. So operating income is 2,000. So that gives you an operating leverage of 10. So what this means is you can use this information, so when you increase the volume that you were selling, then this will tell you right away what the impact is going to be. And we'll see how this works in the next problem. So in this section 5C, we've covered margin of safety, so how much over and above break even are you making in sales, and it's covering operating leverage factor. So now we will move to part 5D. So now we'll use that operating leverage. So here you're asked to calculate the impact of a 5% increase in volume. So here, instead of having to go back in, recalculate your sales, your variable cost, contribution margin, and so on, this is a shortcut. So what we're doing here is we're using our leverage factor of 10. So we're saying 5% increase in the number of units sold using an operating leverage of 10. This means that a 5% increase in the number of units sold will actually increase your income by 50%. So we'll just enter in that number. So our operating income before we increased the volume was $2,000, and we are going to calculate here the impact of an increase in volume. So if you increase your volume by 50%, so that's 1.5 times 2,000 will give you $3,000. So now, just to prove that that actually works, that it's correct, we can do it the long way, which is what we're going to do now, to show how this actually works. So here we have our original sales were 40,000, and if we increase that by 5%, that will give you an extra 2,000 in sales, and of course your variable costs will have to go up accordingly. So times 5% is 1,000. So your increase in your contribution margin is 1,000. There is no change in fixed expenses in this particular example. So this will give you an increase of $1,000 in your operating income. So your existing income is 2,000. You're going to add your increase in operating income as a result of a 5% increase in volume. So this will now give you a $3,000 total operating income after the sales increase. So you see the 3,000 does match. So this works. So here, rather than doing all of these calculations, you're just doing one line. You're saying 5% increase given the fact that you have an operating leverage factor of 10. So 5% times 10 is 50%. So you take your existing income times 1.5, which is 50% increase, will give you 3,000. And this actually works as illustrated in the proof. So this ends section 5D. This next problem that we are going to do is looking at the difference between variable and absorption costing as it pertains to the particular company that we're looking at is Healthy Foods, and the product that they sell are breakfast shakes. So you're given certain basic information here about the company, the selling price, the number of units sold, number of units made, etc. So what we are looking at here is identifying the basic difference between absorption and variable, and it's pretty straightforward. So as the name would imply, variable costing just includes only the variable manufacturing costs, whereas under absorption costing you include both the variable and the fixed manufacturing costs. So with that being said, let's illustrate how we come up with the absorption costing. So we're told here that the variable cost is $5 per shake. Now we want to know what the fixed cost is. So we know the fixed cost in dollar terms, it's $1,000. So we put in $1,000 here, and we are going to divide that $1,000. So that's the number of shakes. We want to divide that by the number of shakes produced, not the number sold. So that's 2,200, because your overhead relates to production, not to sales. So now we know that it's $1,000 in fixed costs divided by the number of shakes produced will give you 45 cents per shake. So we'll just insert that. So the variable cost, the absorption costing for each shake for the month of January is $5.45. For the same month, if you're using variable costing, you only have the $5, and that's it. So we'll go along and look at February. So February, the variable cost remains at $5 for absorption. Now the fixed cost remains the same as 1,000, but you will see that in February the number of units produced declined to 1,800. So now we want to spread out that $1,000 over the 18 units produced. So divide by 1,800 units. So that's going to give you a cost, a fixed cost on a per unit basis of 56 cents. And then the variable costing again is just the $5. So now you can see obviously your cost per shake is higher when you're looking at absorption versus variable costing. So that is the first step in this process, is to calculate your cost per unit under both methods. So now what we're going to do is we're going to look at preparing our income statement using variable costing. So we're looking at, first of all, the sales revenue. And our sales revenue, first of all, we know we have sold 1,600 units, and the selling price per unit is $10, so that's 16,000. Now what we want to do here is calculate the variable cost of goods sold. So we start off with beginning inventory. Now in this particular example, we are not given any information about beginning inventory, so we assume it's 0. So maybe they're just starting operations for the first time. That could be. But anyway, there's no beginning finished goods. So now what we want to do is calculate the variable cost of goods manufactured. So the units that you manufactured is 2,200. So you have to be careful here in distinguishing between the number sold versus the number made. They don't have to be the same, and in fact they rarely are the same. So you made 2,200 units, and I'll just make this column a little larger, and the price per unit, because the cost per unit is $5 because we're using variable costing, so it's 11,000. Then what we want to do is look at what you had available for sale. So it's still 11,000 because you didn't have any beginning inventory. The next thing we want to look at is to identify what our variable costs are for the goods that we sold. So we want to subtract the ending finished goods inventory. So we made 2,200, but we didn't sell 2,200. So what we want to do now is subtract the ending finished goods inventory. So how we come up with that number is, we'll just scroll down here. So as we've stated, there was no beginning inventory for January. We produced 2,200 units. but we only sold 1,600, so that means at the end of the year we had 600 units not sold. So that's our ending balance here. So we'll just the ending finished goods inventory, it's your 16 less your 2,200, which will give you 600 units, and they are valued at $5 each. So that gives us 8,000 variable cost of goods sold. So that's the manufacturing side. Then the other variable cost you have here is sales commissions. So the sales commissions are based on an amount per unit. So we sold 1,600 units, and the sales commission is $1 per unit. So that's $1,600. So our total variable expenses, the cost of our goods, 8,000 plus the sales commission, will give us total variable cost of 9,600. Our sales are 16,000 less 960 equals a contribution margin of 6,400. So now what we need to do, we need to deduct from here our fixed manufacturing overhead. So we are given in the problem that it's $1,000 for the overhead, and for the admin expenses it's $500. So we have 1,500, just delete this guy here. So we have 1,500 in total fixed, so 6,400 minus 15 will give you an operating income of $4,900 for the month of January. So that ends the month of January. So the next thing we're going to look at is the month of February, and we're still looking at the variable costing approach. And the main reason we're doing the month of February is so that you can see the impact of the goods that you had finished at the end of January, the impact of bringing that into February month. So we are told in the problem that we sold 2,000 units in the month of February. So 2,000 units, and they are selling for $10 each. So that's $20,000. Our beginning finished goods, it's 600. So your beginning finished is going to be the same as your ending finished in the previous month. And the value of those, in terms of what it costs to make them, it's $5. The next thing is, we know we manufactured or produced 1,800, so 1,800 in the month of February, and the cost of those is $5. So that's 9,000. So the total cost of your goods available for sale is 12,000. What we need to calculate is what we actually sold. So we know how much we had available. So then we subtract what we had left at the end of the month. The difference is the amount that you sold. So to come up with the value for the number of units for ending finished goods, you would have to do this little calculation. So here, the beginning inventory, so you finished January with 600, so that becomes the beginning inventory for February. You're told in the problem that you produced 1,800 units during the month, so it gives you total units available of 2,400, but you didn't sell all of them. You were told that you sold 2,000. That leaves you with 400 units left at the end of February.